Good afternoon, everyone. My name is Chowdhury. I'm the co-chair of the India Observatory at the London School of Economics. Our seminar today is by Dr. Meghna Chotaliya. She's an associate professor at the RT National College, University of Mumbai. And she's currently visiting us as a Subir Chowdhury Fellow of the India Observatory within the International Inequality Institute at the LSE. Dr. Chowdhury, interests includes regional disparities in banking development, financial inclusion, and its relationship with economic growth, particularly in Asian countries and Indian states. And her work also includes environmental accounting. She's currently working on research projects examining financial inclusion, banking sector development, and environmental efficiency using advanced quantitative techniques, contributing to both academic research and policy discussion. Today, she will be presenting on the concept of how not just quantity, but quality of the shapes transformations. Over to you.
Good afternoon, everyone. So, topic is how banking quality shapes economic transformations in India. So, my session is divided into three parts. Case A, I'm going to cover the global level of this cross-country banking quality measurement. In part of my session will be study of South Asian banking quality. The last and the third part, last but not the least, banking quality at the Indian subnational level, that is states. We call them Indian states. Starting with the first part, Global Banking System Quality Index. So this is a new index which I have developed to measure the quality of banking systems across the globe. And my sample size is 120 countries. The time period is 2010 to 2024. Now, this is a research question. Financial development is usually measured by scale and size. Most of the studies which we have seen till now measure banking development in terms of scale of banking. How many credits, how many branches, how much is the deposit growth. All this shows only the scale of the banking in terms of quantity. What about the quality of the banking? So a state can be, or a country can be deposit rich. You have hundreds of deposits, lakhs of deposits. The question is how much you are able to convert these deposits into productive activities through credits. So mobilization is not equal to intermediation. And India is an ideal laboratory where the situation is totally different as compared to other countries. We have one regulator, that is RBI, one currency, common national stocks, monetary policy is common. So there are variations more which can be seen in the banking systems of the Indian states. Now, quality versus quantity. What is more important? Quantity is measured by size, capital, how much capital, crores of rupees you have as a backup, liquidity, profitability, growth. But quality is capital strength. So I have taken 4 pillars of quality. In this new index, which measures quality, these are my 4 pillars of quality. Capital strength, asset quality, profitability, and financial intermediation. As you can see in the picture, just having a bank with hundreds and crores of deposits is not enough. To lend them and give credit to productive businesses and activities is more important to produce quality of banking. So my research questions are, can banking system quality be measured through a global index, which is transparent, methodical, replicative? How does banking quality vary across countries time. And the new index which I have developed, is it valid? Is it reliable? Is it robust? So the objectives of my session is to develop a transparent BSQI. The new index I have named is Banking System Quality Index. Again, this is very different from the existing index. There is a BSQ which is already done by somebody, but that is Banking Service Quality Index, customer service. So there they measure customer satisfaction through primary data. My index is on banking system quality. And this compares banking quality across 120 countries and 2010 to 2014. And I have validated my index using robustness and empirical tests. So I have framed two hypotheses that my index is a reliable measure of banking system quality and higher index, hence what I refer to index as ASQI, is associated with fewer banking crises. Higher the index, lower the crisis. There is proof of the past crisis which I can validate, and my index is matching with the crisis windows. So, why it is required? There are many quality measures. I'm not saying the quality is not, or banking is not done by anybody. Many studies have done quality measures of banks, but there is not a comprehensive measure. Either they have taken fully non-performing loans, or they are taking regional studies like Urban Union, they are taking stability indices. Here I am covering 4 parameters to measure the quality. And size, again, scale is not equal to quality. Take example, 2 hospitals. Both have 1,000 beds, 100 doctors. Size is same, but it may not be the same. One hospital has higher patient recovery, better treatment facilities. Quality is more, scale is not important, quality is more important. So having fewer banks, but with quality of the banking system in terms of how productive the use of the funds are made is important. And cross-country comparisons always remain difficult because of the data availability issues across the years and in countries. Again, that is again my data availability issues were there. I have taken all the database from the IMF and World Bank. So it is more comparable also. And there is no comprehensive global benchmark. So my index is going to act as a benchmark to measure the banking quality. And my new index will be this one. And my index is very transparent because all the data is available in IMF World Bank. Anybody can verify. It can act as a future, this goal for researchers. They can add to the index, they can modify the index, which I have framed over here. So existing indices are on mostly DEA, data envelope analysis, Quest. They measure efficiency. CAMELS is like a supervisory framework, not an index, which measures the bank soundness. These are bank level, national level, not global level. Yeah, and the limitation is DEA is no system level quality is measured. Only efficiency, input-output ratios are measured. CAMELS has these 6 variables. Yeah, again, these are fragmented. Again, they are not disclosed freely by all the banks. IMF, FSI is more or less similar, but again, a lot of difference. There are core indicators and additional indicators in IMF, FSI. So this again has global coverage, but not a composite quality index. Banking service quality, somebody has done like a service quality of customer, primary data was taken, but again, no credential indicators are covered. So how my index is going to be different? Measurement of quality, most of the literature has done profitability, stability, efficiency, separately examined. There's no single measure of banking system quality. So mine is a multidimensional banking system quality index. Coverage, most of the current studies cover regional studies or single country level studies. So I'm going to cover most of the countries, 120 of the 197 in IMF database, World Bank of 217 cover 20 countries. 2010 to 24. Someone may ask why 2010 I have taken. Because 2008 we had the global financial crisis. After that, there were many changes and many regulatory reforms, banking sector regulations. Hence, I have taken the data after 2010 to 24. Again, 24 there was a major change in the codes of the IMF and World Bank. Then data availability. Okay, so there are proprietary databases, commercial databases. Researchers can't access easily. They are paywalled, Orbis and Bloomberg. But I have taken from IMF and World Bank, which is easy to replicate. And dimensionability, they have most of the literature have taken one or two dimensions, but I have taken four dimensions of the quality. Transparency, construction is often under documented. I don't show how they have constructed the new index, but I am very transparent about the process, how I have constructed the index, and mine is easily replicatable. You can easily replicate any country, any data you have, you can make a new index. And validation is mostly descriptive, but I have done few levels of validation. Validation of robustness and reliability. I have done a robustness battery, crisis prediction, the actual crisis windows, and growth regulations. And policy application, limited benchmarking capability of the existing research, very little use for regulators. And my index is useful for supervisors, regulators, central banks, and researchers. So, four pillars of my index: BSQI, capital strength, that is regulatory capital upon as a percentage of risk-weighted asset. Asset quality, which is very important indicator of quality of banking. Non-performing loans as a percentage of gross loans. Profitability, that is return on assets, profit after tax upon assets. And financial intermediation, that is domestic credit as a percentage of private sector. First three I have taken from IMF. The last one I have taken from World Bank, WTI indicators. Why domestic credit to private sector? Private sector is known and is research, well research to make effective use of the funds. And the fourth indicator I have taken over here. Now coming to my data sample, I already told you, these are the sample sizes. Now why have excluded so many countries? Again, data availability issues, reporting issues. 190 countries are in the database, IMF, World Bank. World Bank has more. 50 are excluded because all the years data. So I have taken a threshold. Minimum 10 years data should be available to be included in the index. If 10 years data is not available, I have excluded. Surprisingly, many countries like UK is excluded because there is no disclosure across all these years. Okay, and 22 complete years are not there. Indicators, some are missing. So final sample is 120 countries. And again, now coming to how the index is made. I have applied weighting. There are different weighting systems, like you have equal weights, which is not again good measure. There are different PCA weights, entropy weights, but I have taken constrained BOD, that is benefit of doubt. Every country, whichever indicator you are good at, I mean, whichever indicator is higher, give higher weight to that indicator. This is constrained BOD. Data-driven weights, no subjective. I'm not choosing the weights. Okay, and minimum weight, I have a constrained BOD. Constraint means minimum weight indicator. 4 indicators, every indicator should get minimum 0.10 weight. Otherwise, what people will do, I'm good at capital adequacy. 100% weight to one variable. Ignore other 3 variables. No, I have given that for every minimum, at least 0.1 weight should be given to each indicator, not below that. And it's a transparent in the index and globally comparable. And the weight constant is between, as I said, 0.1 to 1. Every pillar should contribute. And standardization I have done because the variables are not equally measured. Okay, so to make it standardized and comparable, I have taken Z-score, mean of 100 and standard deviation of 10. Coverage rule, about 10 years data out of 50. Indicator direction, again, out of 4 indicators, NPL, lower the better. The other 3, higher the better. So NPL, non-performing loans, I have to reverse it to make it comparable. So this is my design choices of the new index. And So these are my findings.
Sorry, before you get to the findings, can you tell us how this benefit of the doubt weighting works? Like what's the formula for it? How is it obtained? I know how PCA works. I don't know BOD.
BOD means every country is given, suppose one country is having highest score of out of 4 variables. Suppose one country has higher score on the higher amount of capital adequacy. So weights are given according to the highest variable. You are given to choose your variables as for the highest weights assigned.
But what weight? What is the weight given? So suppose my highest variable is whatever. One of the pillars. What is the weight given to that?
Out of it is out of 1, I have to divide percentage.
Right, but it could be many different percentages, right? It could be
When highest, suppose your capital adequacy in the particular year, one variable. Suppose capital adequacy has highest score. So instead of giving 100%, I'll give highest weights according to the ratios.
right, but you say the minimum is going to be 10%.
10%.
Then it could be 10, 20,
Yeah.
and 60,
Yeah.
or
Yeah.
it could be 50, 30, and 10, or it could be 20, 30, and 40. I mean, how is it chosen?
Obviously starts with minimum 10. One will be 0. Yeah.
You could still a lot of
Again,
flexibility.
it's a ratio of the variables to the total.
It's the ratio of the variables to the total.
Like suppose a student has got good marks in maths and not good marks in English. Obviously, maths will be given higher weights and English will be given lower weights. You choose. But again, there may be possibility of gaming. So to avoid this gaming, I put a constant. Okay, and so global banking system policy rankings. This may be a surprise figure for many of you. Hong Kong is the best country out of all 120, having the highest index. Nor followed by Norway and Guinea, US, Korea, Luxembourg. But now somebody may ask, why not US first? Again, I said, good banking quality is not measured by development or wealth. US may be wealthy, but the quality, maybe there are a lot of debts. US. So it is not the best as the quality dimension which I have taken for the 4 pillars is not good. The funds are not utilized. You may have fewer banks, but more productive use of your resources is important. And the bottom 10 countries are Ukraine, Equatorial Guinea, and Comoros. All these, most of the crisis countries, you can see Ukraine, Greece, all these are having lower ranks as per my index. So this is the global distribution of the BSQI. And now coming to out of the 4 indicators, my findings are.
So do you mind going back to the map? I'm looking for Papua New Guinea.
New Guinea has a
I think Papua New Guinea is where it is. It doesn't have it. It was your third highest.
Surprised by that too. I was thinking, yeah, what drives it, which weight?
But here is Papua New Guinea where I think it is. Is it that orange bit there?
Just above Australia.
I say Australia and Equatorial is Africa.
So I think
So
the
that's
orange,
between 0.75 and 0.799, right? So it can't be the third highest.
Unless it's the green part. PNG might be the green part beside the orange. Because it's having high, I was looking for that as well, because if PNG is 0.978, according to the index, it would be one of the green islands.
It has to be the very dark green, like Japan, not like Indonesia. What you're pointing to is Indonesia.
Okay. Thanks.
So that doesn't seem to be consistent with the ranking, right? But anyway, that's just Papua.
You have to check the
I checked it, yeah.
ranking versus.
I just check it, yeah.
yeah.
I have confirmed with the rankings. I think this might be or something or different thing, but rankings are proper. Just check the
It's one of those clusters just above Australia, so it depends on how does it match. If PNG on your top
It's very
left,
small.
yes, it
Yes,
is.
you're right, the orange
It's
bit,
the
so I
orange.
think the coloring is
Not
probably.
visible, it's very small.
But PNG is one of the largest. Well, PNG is the largest.
This
in
one,
that
yeah.
area. Well, it's, I'm just checking.
Anyway, it
This
doesn't
is
matter.
Oceania and Australia and other.
So according to, I'm just looking at the map. So it is the green orange, the part that's there. It's probably more the orange color, which is more. Moresby is on the side where the orange is, so which means it's looking at this map.
It's also surprising, all of
Right,
us
right.
were looking in Papua New Guinea, so I think you will probably get more questions on this. I was surprised to see it in the ranking that high up, so I would be worth checking a bit more on that case.
Because these 4 pillars, as I said, anybody would expect that US would generally be high.
We're taking example of PNG, which I know PNG quite well. I'm surprised with PNG having such a high ranking. So this is where the question of what criteria have you used for the index is what is, I think we are concerned about.
Well, that's a substantive concern.
Yeah.
I'm making a much smaller point, which is there is a typo somewhere, like a error, in the sense that you cannot be 978 and have this color. So that's nothing to do with how the index is constructed. It's like a mistake.
This part, yeah.
Yes, hopefully the number is wrong and the color is right.
I'll cross check that again. The variables and the calculation part.
And would it be possible to understand those 4 pillars a bit better? You were showing what it means, but I think
4 pillars. You see, first is asset quality. Actually, first is capital strength, that goes below, because capital strength is regulatory capital as a percent of risk-weighted asset.
how do they collect all the data? Like, do they get it from all the banks?
IMF financial soundness indicators has this data.
I know, but I'm not familiar with those. So can you explain it a bit?
So regulatory capital and risk, where regulatory capital is minimum capital which banks have to maintain as per the central banks of the country as a percent of risk-weighted assets. So there are tier 2 capital part and tier 2 one has 2 components, and tier 2 the total risk-weighted assets as a.
And is this data self-reported by countries or is it collected by IMF?
So how they do it, basically IMF, all the countries who report over, all the countries don't report to IMF, FSI. So those countries which report, all the banks hand over the data to the central bank. Central bank validates the data and makes one common database and submits to IMF. That is how it works. Then we have asset quality. Loan. This is the most important. Without even looking at the numbers, I can say as a generalist, like non-performing loans is the most important indicator of quality. Okay. Non-performing loans which are bad, people don't pay on time.
This is a big issue in India, the non-performing loans.
In India, we call it NPAs, non-performing assets. Loans are assets for the banks. So if the money doesn't stop coming, principal payment, EMIs stop coming, people don't pay. So it is a non-performing loan out of the total loans.
And it's one of the biggest banking challenges.
Okay, and financial profitability is like total net profit after taxes upon assets. And financial intermediation is, as I said, credit as a percentage of GDP. This is third. Financial intermediation is taken from World Bank, and the other 3 are taken from IMF, FSI indicators. So that is why this index, and because the data is replicable, replicate and check, cross check, and many data replicable. The data like they are paywalled, as I said, Orbis and all. So it's very difficult to do a regional study or some other study. So this is the most important aspect of my index. Okay, and So asset quality is the main driver of the quality, followed by profitability and intermediation are at the same level almost 0.14 and 13. Capital strength is only 0.12.
So you have only half an hour left. So
Yeah.
I know you've
Yeah.
got lots of slides.
Yeah. So the mean index year-wise. The most important part will come now, crisis windows and index to verify. So as you can see, obviously 2008 were the crisis window, global financial crisis. Most of the indices were having a decline over the years. After 16, it picked up. The reasons are different. Where your regulatory frameworks, intervention of governments of countries and central banks. And recently, 23-24, the index has picked up. This is year-wise reporting I have done. Again, COVID years, it went down. Again, regulatory intervention was there, protection by bank, governments and central banks resulted in the index going up year-wise. So now most important part is my crisis windows I'm going to cover and compare my index because as a decline that comes under a crisis window. Okay, so mean index, crisis window and non-crisis out of my observations, which is 1650. I take 120 countries and 2010 to 24, 14 years, 15 years. If I take, I get 1650 observations. Out of that, crisis years were 24, remaining were non-crisis years. So crisis years had a minor dip, not major. Yeah, because except one or two exceptions, Greece, Ukraine, Cyprus, there were many banking crises. They couldn't recover quickly. And in other cases, the recovery was fast due to intervention measures. Okay. So this is about the crisis and non-crisis windows. So crisis episodes I have taken. I should do this first. I'll do this and then I'll show this. So that I have taken 8 crisis episodes, the fall and the recovery. In 2010-11, there was a banking. Again, this is banking crisis, not the other. COVID is a public health crisis. I'm talking banking crisis here. Denmark, Greece, Ireland, these are the different years in which the episode had happened. So I will call it T0. So in those years, the index was this much, I calculated. And the lowest point year in the particular year, not that year, but in which year the index was lowest in the crisis point. As you can see, Ireland 2012 was the lowest point of my index was lowest 0.838. Nigeria, Cyprus, Spain, Moldova, and Ukraine. Ukraine had a very big crisis and still is like recovery took a lot of time. And 5 years down the crisis, what is the new index? After 5 years, how recovery was made faster or not? So decline was like you can see the decline. Nigeria covered up quickly. Spain and Moldova recovered. The worst case is Ukraine. It couldn't recover quickly within 5 years also. So this decline shows how quick the recovery was in terms of index. This is the most important. Many indices have been done. They have never connected with the crisis window. So this gives validity and reliability for my indices. It connects with my crisis windows. So countries which are having a crisis, the indices went down.
So the maximum decline is not only about from the lowest point to 5 years, but it's it's typically from the onset to
Yes,
the lowest point.
Sometimes again, its immediate effect is immediate. Sometimes effect takes effect may prolong to 4-5 years. And again, how quickly you're rebounding back due to intervention and government measures, that is reflected over here. These are my crisis and my index validates this crisis windows, and this is what is shown. So these are the crisis countries, and so T0 is a year of the crisis, and minus 5 years and plus 5 years. Before 5 years of the crisis, 5 years after the crisis, and the whole mean is that orange. Right?
How some of these defined as crises? Because some of them seem to not have much of a decline. So
Again, that is the IMF. There's and Valencia. They have systemic banking crisis database. So from that, I have picked up.
okay, thank you.
All right. So my results validates this. But yet, there are many stress events. Again, stress is different from crisis, I would say. A person may have fever. He's stressed. You will not go to an intensive care unit. He has a heart stroke. It's a crisis. He has to be admitted to ICU. Similarly, there may be losses. Okay, that is not a crisis. That is a stress. But all stresses don't lead to crisis. So these are the events with the global mean. I have taken COVID. It was a stress, but it never resulted in a crisis because of the intervention measures by the governments and central bank, moratorium, fiscal measures, monetary policy changes. Then they have given many NPA, or you say, this thing, recovery periods were postponed. So that is why COVID was not a crisis, it was a bad event. It was a public health event, an economic event, not a banking crisis. India also, NPA cycle was very bad. At that time, a lot of loans were there, but repayments stopped suddenly 2017. And then government had injected new capital, recapitalization happened. So India was in a stress, not a crisis. So I have not taken that wind. Turkey is again currency crisis. The currency appreciated a lot, but banks were capitalized. Rescue programs were not there, but they could manage out of the stress. Argentina, peso crisis, IMF, all that. Again, sovereign currency crisis. Liquidity was affected, but not a crisis. And Bangladesh, the stress was there, right? Loans, governance issues were there, political issues were there, but they reclassified and they managed to come out of the event stress. So my result about the that was about the validity of my index. For robustness, I have done 3 checks. Instead of 0.1 minimum weights constraints, I have tried at 0.05 weights. I have tried applying the weights at 0.15. So the changes in the rankings were just 96% changed. The remaining were almost, 96% remained same. So only few changes could be seen in the rankings. I applied the outliers like visualization, what we call it. The top outlier and the bottom outlier removed. And saw the rankings didn't change much. So my index is not outlier driven. Then I dropped the one country and if worked the index, it was stable. So these I applied the robustness checks of the index.
The reweighting robustness is a fairly modest test, isn't it? You just took the weight from 0.1 and you let it. What happens if you use PCA for it?
PCA again depends on the variations. If there are more when crisis windows are there are more variations in the database, obviously the ranking would change.
Do you know what that correlation is with your index if you had used PCA instead?
PCA, yeah, but I have it in a separate
Lower than that, I'm sure.
I'll share it, yeah.
I had a similar question also, what would the weights be? Because now you have basically 0.6 for asset quality and for the rest you have around 0.1. So I would be curious whether they change, would the others gain more weight or how would that look like?
No, but I tried with PCA. First try this is a constant. Instead of 0.1, I tried at 0.05 and 0.15.
But I mean what the weights from the PCA would look like.
Again, PCA gives higher weights to those variables which have more variation, and lower weights to those which have less variations. Again, it depends on the data. It's a big database, so many countries and so many years. So PCA weights might change, but the change is not much in the index rankings. Not much. So it again gives a validity to my index, which I have constructed. Trim it again, outliers have removed, drop one country. So the particular country should not dominate overall, ranking also in every subsample. So, and so my conclusion is a large banking sector is not necessarily a good one. Okay. So, size is not important, quality is important. And size is measured by how much the banking economy does, quality is how well it works. The second part, I'll quickly rush with it, South Asia. Before coming to India, I have done South Asian analysis. In my index, these 5 countries were a part of the sample. The other countries, Afghanistan, the data is not there. Other Nepal and all. So these are a part of my index. Hence, I picked up in this sample. So analyzing these South Asian countries before coming back.
You didn't have Sri Lanka data?
No, the data again, data availability issues are the big constant. So Maldives was the first rank. It has a less number of banks, but the intermediation quality, asset quality is very good. It's well managed. Productive use of the funds are happening in Maldives. Bhutan also first, it was like recovery was mid year. There was some crisis, but they recovered it. And India, I'll come to it. It's a U shape. So India, the index is around 83 or something out of the 120 countries. Again, that 2016-17 NPA cycle crisis was there. But after 2020, much greater extent. Pakistan, again, it is improving a lot from 0.845 in 2013 to 0.920 monotonic. And Bangladesh, first it dropped from 0.945 to 0.7. It's the lowest index.
Because you see, these countries have a lot of diversity, or these 5 South Asian countries, even if you look at the population. For instance, Maldives population is less than 1 million. Yeah,
the population is not covered an index. So
no, but the point is, how does that affect the banking sector itself? When you have small countries with small population and small number of banks, how does that influence these indicators?
Again, the quality is measured in how well the funds are used, capital is used, capital buffer is strong or not. Is asset quality and profitability higher on the bank.
But my point is, those are influenced by the country's other demographic itself. That's the question I'm asking.
I'm not taking that into consideration. No. Because
that's okay. No, but with what you've got, this is what you have. Carry on.
So for these 5 countries, my index shows these 5 stories. Now coming to last but not least, Indian states. Before I start, again, the biggest problem I had is data collection issues. I met sir and I told quality I have to measure because state-wise, sub-national. So again, the proxy for quality is NPA. So NPA data is not available state-wise in RBI data in India. So I had to choose a proxy. So I again changed a lot of times, this part, but finally I have arrived at something to work out the quality indicator. So I'm not taking my new index over here. I'm taking different measure of quality. So quantity I have taken one variable, which is the PCA computation, and quality one proxy. So directly it's standardized. So 30 states. Okay, I'll be very honest. First step of 14 states. Clean data, availability, I wanted time series, I wanted 10 years, 15 years plus. Data was not uniformly available. I picked 14 states, and you can call it cherry picking to get significant results. So 14 states I tried. These 14 states were very developed states, industrialized states, contributing much to the GDP. Then I tried with, I want more data. He said, let me reduce, Dr. also said, reduce the years and take more states. So after working out that, I'll be honest, but in 14 states, quality is important. I take 30 states, quantity is important. That is my finding. So the data. Okay, so 2015 to 24, RBI data again. So I study banking. How India is different from the cross-country analysis which I did. Okay, one policy regime, we have central regulator. In cross-country index, there's no common regulator. We have RBI, one common regulator, common banking policies, uniform monetary policies, interest rates are uniform, everything is controlled at the central level. Yet, states are heterogeneous. Different banking structures, credit deployment, economic growth. Okay. But again, data is not available as needed for the index over here, so I had to change it. So the data I have taken 2 main is BDS. This is not an index, this is a score. BDS is banking debt score, BI is ranking intermediation efficiency. BDS shows quantity, BI shows quality. Here I've taken in BDS is deposit per person, branches per capita per person. Intermediation is how well deposits are channeled into productive credit. So taken credit deposit ratio as per utilization, not sanction as per utilization. And credit per branch, how much credit is given by banks. Outcome is the dependent variable is log of gross state domestic product GDP, that is state level GDP at constant prices. I have taken one only control variable, that is electricity or power availability per capita, because it's made power is measured like for industrial use, so hence taken as control variable. So 30 states, okay, so 293 state years I got. So I again only taken PCA, nothing else. Only PCA for the two scores, quality versus quantity. To arrive at the scale, common scale of 0 to 10, weighting again between 0.1 to 1. Before, first I started with state, 14 states score. After that, I tried with 30 states.
Right. So do we go back? So here you say something about SPQI. You're not using the SP.
No, sorry, actually, yeah. I tried that. I couldn't get the variables for different, actually.
There were two variables.
BDS, CBI.
So you use the PCA between those two
the
variables.
PCA of these two variables in depth and intermediation efficiency, two variables. When I took a PCA of that.
Okay.
One is quantity, one is quality. At least the nearest proxy I got.
You just put them in the you're gonna run a regression eventually?
Yeah, I've done everything. I'll show the why not put it on slides.
But why don't you just put the two variables separately in the regression?
But separately, if I take, but again, I can take separately, but I want standard variables.
You have one quality and one quantity.
Yeah.
So by taking the PCA, you conflate them into one thing. Whereas if you kept them separate, I mean, not that you could identify anything from linear regression like this anyway, but just for you to understand why you would specify it by taking some sort of weighted average, which is a PCA.
To standardize it, because then there are a lot of variations in the states, northeastern states, and again, data availability issues were there. So again, better to start. I tried with, I showed you one, once you said proxy, what is big number 50. The others were coming between 10 and so again, that was an issue. So better to have it reliable, have a PCA weights, at least common, First I tried with PCA, quality score is PCA, and raw data. And again, it was not comparable. Those were between 0 and 10. These were in percentage, and proxy is coming in with PCA score. So to have a uniform comparison. And so again, BDS versus BI, quality versus quantity. Okay, if I take 14 states, this is the situation. And now ranking I have done. Similar to the global index. Here as per BIE, that is quality score, I have ranked the states. The top 10 and bottom 10. Top is Delhi, Andhra Pradesh, Telangana, Tamil Nadu, Maharashtra, Kerala. And all these are the top 10 states of quality in terms of quality. And the bottom is Bihar, Goa, Jharkhand, UP, Arunachal Pradesh, Assam. Schools. Showing quality indicator, quality score. South Indian and these East northern states had a good quality as compared to the northeastern states.
How did you draw these maps? How did you draw this map?
These are AI tools which you data and they give them maps.
Look at where Delhi is. Delhi is not where it should be. So this is where I think
it is our point. It is there.
It is, oh yeah, it's located in, maybe this is where the PNG question also comes back, yeah?
Maybe, yeah.
So maybe the AI when it's generating it, because again, you have a higher score for Delhi in your results,
Maybe this is
but it is not in the leading highest.
Yeah, this image issue, I think that is wrong. Even in world map, this also. I think the indicators are properly done. This part is, I think, having some issue.
You may want to check.
Yeah, I checked that.
Yeah.
And what drive? These are again the top and bottom. Again, here also I did some robustness checks by dropping one state at a time. We call it jackknife table. There's not much changes in the quality component. Shorten the window and add those, as I said, first I took 14 states. Okay, then I took 30 states. 14 states was giving me a significant result, and 30 states again, quantity had major, what do you call it, quantity was higher than quality. So I will conclude by saying that a state can be rich in banks, but banking it may be poor. Goa has a dense branch networks, more deposits per person, but it's not lent. Credit is very less. Deployment of credit is very low. Out of 100 rupees, 27 rupees is only lent. Mobilization is there, but no deployment of credit. And Tamil Nadu, 110 rupees of credit deployed for every 100 rupees of local deposits. My findings is quality beats quantity. So intermediation efficiency, not depth. Quality is more important than quantity. Depth alone is not in quantity alone doesn't result in economic growth. More mature systems, 14 major states, the contribution to GDP is higher and the quality effect was seen more in these states. Heterogeneity matters. When you pool all the states together, the signal that quality is better is hidden. You take the data of the better developed states, quality wins. Measure quality and target efficiency. So for policy implications, RBI shift the yardstick from branch expansion to don't only go on expanding branches. We had Pradhan Mantri Jan Dhan Yojana in India in 2014. They wanted everybody to open a bank account. But what is the use if the accounts are open? Nobody is using those accounts, no deployment of credits, no deposits. What's the use of having branch expansion but no efficiency of the money deposited over there? Okay, so monitor deployment, not just presence. For banks, credit deployment where deposits should not remain idle. Obviously, banks would invest somewhere, they will not get that much returns. Then state governments, we have India, we have state government and central government. So those states which don't have good quality, go for bankable projects, credit absorption capacity increase, support productive sectors who don't go for unproductive lendings. And for researchers, measure banking quality, not just get numbers. So what we are license declarations. So I would like to end by saying that research consists to a large extent of failures. As I had done so many times for 2 months, I was working on the Indian database, I tried so many things and I had failures more than successful steps. But of course, in the first moment, failure, it doesn't feel nice, but I learned a lot developing this index. Laureate.
I mean, this is more of the future-centric question that nothing on this particular thing. Most of the variables that are used in the indices are still quantitative. And if, say, I think I'm drawing on what she was trying to ask that. How do these variables are defined? They are quantitative. I mean, they are basically what the money does. Like you have money lent by the bank and the bank is giving it in a way that it's more productive. So that has much less to do in Asian countries because you approach a bank more of as a deposit or as a loan, and it's mostly around the day-to-day life, the basic life. It's not like to invest the money and you generate your own. So can we have something more on quality? I don't know if the data is available with any of the dashboards for them. Is there any possibility? I'm looking at it as in terms of, say, you talk about economic growth, then human development, which is actually taking income as one of the component, but the others are non-economic aspects. Is there anything that kind of a variable that is possible?
There are, like in banking, if you talk, there are different services, as I said, service quality, customer service quality, liquidity is also I didn't cover. Liquidity important. Different aspects of banking which cover different types of quality indicators are there.
Yeah, maybe adding one of them, even if this service could alter the indicator.
But then somebody's already done, like I told somebody's already done a banking service quality index. So it will not be something new. This is something which is new. I have done a lot of literature review. I didn't want to do the main thing important about new index is easily, it's methodical, it's replicable. IMF World Bank or anybody can access for free, and it's like proper measure of the main quality aspects as per my estimates. I cannot link it. My index is this, and hence I can link it to Basel III norms were implemented in 2018. After that, the index went up for most of the countries which had Basel. I cannot say there's a association, not causation. I cannot say it's causing. It's only associated with that.
Still trying to understand this benefit of the doubt weighting thing. So it's some sort of proportion of the individual score to the total, something like that to say, right? So the different rankings of the different variables, but the exact weight you get is that number divided by some sort of sum, is it, or something?
Yes, divided by sum. The highest, suppose a student gets good marks, one student gets highest, say out of 100, highest marks in English 90, followed by 80 history, science 70, math 60.
I take those numbers and divide them by the total.
The numbers or weights, I've taken points, percentage, you take on points.
And here they are completely different scales, though, aren't they?
Yeah.
These four variables.
Only for the, I mean to say the BOD is already done. Rachita Gulati also was one person who has applied this BOD for banking governance index. Okay, so BOD may you give maximum weight to that indicator which is good. I mean, the score is good. That indicator scores highest out of 4 indicators. According to highest scores, you give the weights.
I understand that. Yeah, I got that. But so the indices then will be different from country to country. The weights are different.
Again, weight to selection is a criteria which I had to think a lot. I could have done equal weights. Somebody will question like every weight you choose, there will be some pros and cons. So
they are different.
Yeah. Some obviously some differences
within a country over time. Are they also different, or do you fix them within?
Obviously, it will be different. Now, suppose one country has a good capital in a particular year, there's a crisis, and the NPL goes up, so obviously indicators would change.
So not only are the variables changing over time, the weights given to those variables are changing over time. And in fact, if something goes terribly wrong, it'll get a lesser weight.
Yes. That's why the benefit of doubt we call it. But then they may be gaming. To avoid that, I would take
If I wanted to use this index to warn about crisis, I wouldn't want the weight on something that's going bad to go down, right? Because as the weight goes down, that shows up less and less in the indicator. I'd like the indicator to be sensitive to things that are changing. At least I like the weight to stay the same. Do you see what I'm saying?
Yeah.
That if the weight on a variable that is getting worse is going down, you're understating that variable. You're discounting the decline.
That is, I would say, BOD, constraint BOD might be biased. Countries might game it, but again,
no, it's not about gaming it. I don't know. Game it or
not gaming, but
just whether it's a suitable weighting scheme for what you want. Obviously, you thought about it, but it seems to have some features that are. I mean, the endogeneity of the weight. I'm not sure I'd want it in an indicator that is meant to serve as a warning to policymakers about things getting better or worse, for example.
Okay, so again, this is just I'm not again published it. I've just tried working on the index. Again, I might have to. I'm not any that.
Think a little bit about this point, maybe.
Okay, so I'll just think and see how it works. Which type of other weights can be applied? But again, if I take any particular weight, I will do robustness checks with the other weighting techniques. So that I come to know now the difference. If I take the main, my index is suppose equal weights. And for robustness checks, that is why I have taken other weights checks also. So that I'll surely cover. So I'll try to cover more on the weighting techniques in my robustness checks so that I get a proper way. How should I go ahead before publishing it?
I mean, I think that's a crucial point, the weighting, right? So I think it deserves more discussion. So and then you had in the end, I saw in the appendix you had the PCA weights, no?
I have in my Excel sheet.
Do you want to show us? Like I think one or not. Did you have it in there?
The appendix of few things.
I thought before the photo that you showed us with this really nice citation, I thought there was
What to say? He says is right. What he says is correct. That weighting part I have to cross check. But that again, I will surely do one thing that if I'm taking PCA, suppose if he suggests PCA, I will do robustness checks with all the other weighting techniques, so that I get a perfect.
Show us the PCA thing that you had there.
because if you present an index, everyone is going to ask you about the weight. So that's why I think it's important to include it.
Just check whether I have it or else.
Didn't you have it in the slides? Sorry, I thought that before the
Show the appendix.
appendix, I thought the quote that
Appendix.
You have
1 minute.
in the appendix.
Just check a few things I had put and I didn't take everything. I think these are the 120 countries rank.
I think it was 8, 9, or 10 or something. One more. The one, or even
This one.
12.
Yeah. I've only taken crisis windows, not all.
The next one, here.
There,
They have the PCA weight.
0.61, 0.62 is the correlation.
But see, two countries actually I had taken first that I removed 120 because two countries, the latest data was 2024, 1 year data was not reported by an IMF. So I will still cross check before publishing it. I'll confirm and see all that all the weighting different weight options.
So it's clear from this that, as we were saying earlier, that the results may be quite different in PCA, right? Because the correlation is there, but it's not. And I'm not necessarily a big fan of principal components analysis in general, but I think it's may in this case be preferable to this thing that has variable weights, with the weights change across countries, across years, so the weights are changing everywhere. At least it's a benchmark. I'll tell you what I think the problem is.
I'll go ahead with I just to see how it works if I take PCA before publishing the new index.
You've already computed it.
Yeah, I'll try and compute and see.
Anyway, great. Thank you.
But do you want to finish what you were saying before she interrupted when you talked about?
No, I was going to say, in general, what is an issue with PCA is that PCA is about the variation in each of the X variables. What do you want the weight for? If you want the weight to reflect the extent to which the X variables are predictive of some Y. In some sense, you'd like for there to be some sort of measure of the association between the X's and the Y. So some sort of regression coefficient or something might be preferable to the PCA, although then you'd have to think exactly how you specify that regression and whether it's over the whole period, the whole sample, and then you keep it fixed afterwards. But PCA at least has the advantage that people know what it is. It's very often used, and this BOD was news to me, and as I understand a little bit more about it, I think I understand why it's not so often used. So you could do a PCA versus some other thing, which is like some sort of regression-based index of some sort. Yeah, but I'm not an expert on this stuff.
Here's what I found. PCA and BOD comparison, feature, primary goal. This is first is PCA, then BOD. So feature primary goal explains maximum variance and cuts out data redundancy. That's PCA. Whereas BOD benchmarks efficiency and performance fairly. And then you've got weight assignment. For PCA, it's universal, applies the same empirical component, loadings to every entity in the data set, whereas BOD, endogenous, individual, every entity gets its own unique weights tailored to its strengths. Then the third point it makes is objectivity strategy, driven purely by the statistical covariance of the numbers, whereas BOD is driven by revealed preference, giving the entity a fair chance. And the last point it makes, value scale. Scores are abstract numbers centered around 0. BOD scores are easily interpreted percentage 0 to 100% efficiency. Now, I'm actually very impressed with
Benchmarking is the right word, I think, and say it's a benchmarking thing. I wanted this a benchmark for predict future crisis.
Thank you very much.
Thank you
Yeah,
so
thank
much.
you.
It was very interesting.
Yeah, thank you all for coming.